Southeast Asia's second largest bank, OCBC, has reported higher earnings in the first quarter this year, with income from its wealth and insurance businesses hitting records. Net profit for the January to March quarter rose 5% on year to 1.97 billion Singapore dollars. That is higher than in the previous quarter and also beats market estimates. Well, net interest income declined by 5% amid a lower interest rate environment, but non-interest income rose 23%, driven by its fee, trading and insurance income. Well, looking ahead, the lender's CEO, Tan Teck Long, says global conditions remain uncertain amid geopolitical tensions and elevated inflation risks. The bank has maintained its targets for this year. It estimates stable income growth with a moderate decline in non-interest income. And with that, OCBC wraps up the Q1 earnings season for Singapore banks. DBS reported higher first quarter net profit that beat expectations. Earnings at UOB fell last quarter as a lower interest rate environment dented its lending income. And for more, we're joined by Harsh Modi, co-head of APAC Financials Research at JP Morgan. Harsh, thank you for your time today. So all three banks beating consensus there despite shrinking margins. So how would you assess the quality of this beat?
Thanks a lot, Liz. Yeah, it is a very interesting set of results. Most of the banks are looking at net interest income rather than net interest margins because Singapore banks have fantastic liability franchise, which means as interest rates go down, they cannot really reduce their cost of fund very quickly, but the asset yields comes off, which means if the banks are able to manage via mix change or hedging and are able to deliver much better net interest income growth, that is what all the three banks have been focused on, and to varying degrees, they have been successful. And we do expect net interest margin will probably go down if SORA goes down, the interbank rates go down. But net interest income is where most of the investor discussions are.
Yeah. So that is also, we saw the NIMs narrowed for us as central banks move away from the higher interest rate environment. But with rates set to remain where they are, at least for longer amid the Iran conflict, energy crisis, ensuing energy crisis as well, and traders increasingly betting on a hike by the Fed even. How do you see this NIM component evolving for banks?
That's a very interesting point, and you're right, Liz. We are at a point of a bit of an inflection in rate expectations, and we have seen Singapore interbank rate SORA move up in last 10 odd days. So it does give reason for optimism that NIMs may stabilize, but again, early days, a lot of things can change here. And what is very interesting is for dollar rates, as in SOFR and Fed rates, if they move up, it may not have necessarily a one-on-one impact on Singapore rates. So the difference between the three banks on how are they hedging their books and the banks which are able to do a better job of hedging, especially the dollar rate risk, are having a much better impact on net interest income. So the differentiation between the three banks should be quite important as we go through this period of inflection in rate expectations.
Yeah. Harsh, the wealth business was pretty good for all three banks. Is this becoming the defining earnings model for Singapore banks, or do you think this is just maybe a temporary windfall from the safe haven capital flows into Singapore?
Oh, no. This is structural, Liz. This is absolutely structural. And this doesn't happen in a matter of 1 quarter or 2 years or 5 years. This is 10 to 15 years in making. We had an acquisition 15 odd years ago by one of the Singapore banks, and then another large Singapore bank ended up building a very strong in-house private banking label over the last around 15 odd years. And this kind of marries with the concept of Singapore as a financial center, which is broadening, and we see all the initiatives by government, by SGX, on value unlock and so on and so forth. So there are multiple moving parts here which are all coming together and helping this broader narrative. And that we think is structural. It is not something which is just a safe haven flow. It takes a long time to become a safe haven. And yes, definitely the recent global events do have a relative positive impact. But that is not the main reason. That is an added
Okay.
advantage or bonus.
Okay. And also, just a few weeks ago, we saw OCBC's acquisition of HSBC's Indonesia wealth and premium banking portfolio. Probably one of the most significant strategic moves announced this earnings season. And I wonder what it says about perhaps the lender's regional ambitions, or maybe where do you see large-scale M&As headed for the rest of the year? I mean, the three lender CEOs, they have flagged global uncertainty. So, could we see a more kind of a wait-and-see approach for the rest of the year?
See, again, any of the transactions, they take long time in making. It needs to be a very good fit. It's on a willing seller, willing buyer basis. The regulators need to say yes. So these are very long gestation. But more importantly, I think Singapore banks have been very, very, very disciplined on any inorganic growth over, I want to say, last 15 years, 10 to 15 years. And that we continue to see going forward as well. Yes, they do have capital. But if you think about it, all the three banks have been using capital either for buyback or for dividends, both regular and special. And we still think that dividend payout, both regular and special, as well as buybacks, will be the dominant use of excess capital. And if there is something really compelling with a very great fit comes through, then the banks will evaluate. Otherwise, that is not a matter of priority. Because with the growth, as you pointed out, on wealth management and other bits, is going pretty well. So there is no immediate need to do acquisition for the sake of it.
All right, Harsh, we appreciate you breaking this down for us. Harsh Modi, co-head of APAC Financials Research, JP Morgan.